any further proceeds like that are really not expected by the market. Now that they've paid down the debt, these kind of things can go back into buying more shares back. They're not looking to do deals. They're not looking to do huge amount of capex. They are looking to generate returns and really start to show shareholders that they mean business here.
Here at BBAE, we're always trying to bring you trading ideas or investing ideas, depending on which vernacular you prefer. And this week, my guest believes he's found a stock that could have 40% to 50% upside. His name is Rich McDonald. He's not just a man with a passion for markets who's worked at Credit Suisse and one of the biggest European hedge funds out there. In fact, he made 25% returns on 50 million in capital during the financial crisis, which is pretty impressive. He now teaches individual investors about investing, and he's here with me today. So Rich, welcome.
Thank you very much, James. Happy to be with you.
Rich, I think you are a near Olympian on the side or work. Can you explain that briefly?
That's right. In my late teens, I was very lucky to get over to University of Southern California. I was born and bred in Scotland, but athletics was my real passion through my teens. And 400 meter hurdles, I was very proud European champion and the fastest Scotsman ever. And then went on to run in the Commonwealth Games, and just a fantastic opportunity to get out and travel. With the Great Britain athletics team, and my as I say, my event was 400 meter hurdles, so it taught me to clear barriers when they come up at you fast.
Nice. If that were me, I would have a sticker saying "fastest Scotsman ever" and stick it on the back of my car. I'd have T-shirts emblazoned. I would totally run with that as an ego booster. But you're much more modest.
Oh, I didn't say I didn't have those.
All right. Let's get down to trading. So what is or investing? I'm using the terms interchangeably, but I think of myself personally more as an investor. Some people are more traders. In my mind, trading has a shorter term duration, but that's something we can unpack today. So what is your trade/investment idea, and what do you see that the market doesn't?
Yeah, well, to give a very quick introduction to the stock, I see a company that is unloved, unfollowed. They're giving 25% return to investors in the next 18 months. And it's just not even registering on anybody's radar. So it's very exciting. But to give you a bit of a background about my investing as well as my athletics, I started off as a market maker. Yep. So the trading side really appealed to me. And, that was what started all this the ability to follow trading patterns and get into the movements of stocks. But then I moved on and became
because it's a market maker, Rich. You're not actually, sorry to interrupt, but you're not actually setting. I mean, you are setting prices, but sort of indirectly. You're not supposedly bringing a ton of new information into the market. You're basically making the market versus someone who's a hedge fund and is technically a more informed participant might come to the table with something new. Am I seeing it accurately?
That's absolutely right. And we see huge client orders. So clients would come to us and say, right, we've got $200 million of a mining company to buy. We'd like you to work that carefully in the market over the next 3 days, right? So you get a real feel for what's the volume of the market, what's the supply and demand, and you can tell when something's about to move. What I also had to do there was company buybacks. So we did a huge buyback over 2 years for a mining company called Rio Tinto. Okay, now, so a buyback is obviously when the company feels it has excess cash, and one of the best investments it can make is buying back its own stock and then cancelling them, which of course improves all the metrics of earnings per share, free cash flow per share.
Return on equity, things like that.
And return on equity, exactly. So this gave me a great grounding. This was at Credit Suisse back in 2004, 2007. And then I was lucky enough to move to Europe's second biggest hedge fund and become a junior portfolio manager. So I had to take all that trading knowledge and then add on fundamental analysis, macro analysis, and just create a much bigger picture and as you say, a bit more longer term holdings of stocks rather than 1 day or 1 week. So that's what I've been doing now for the past 15 years. And something came across my radar. It was a stock that I have traded before back in 2018-19, but they did a horrible deal. And they've been, gradually unwinding that for the past 4 years, and they've been punished really hard for it. But now with a new management team, with lowered net debt to EBITDA, with improving growth, and with a really exciting return to shareholders, then Vodafone, to me, looks like it could really have a 40 to 50% move in the next 18 months. And it's a stock that is headquartered in London. As you can tell from my accent, I am UK based, but its biggest operations are in Germany, but it also has a stock listing in America through an ADR. So it's available to shareholders, potential shareholders all across the world. And I'd just like today to take you through some of the reasoning behind why I think this is one of the most exciting investment opportunities that I've seen in many years.
Oh, we love that. We love that. Let me challenge you with a question right from the get-go. 40 to 50% upside is obviously fantastic. Everybody wants that. Vodafone, though, basically sells a commodity or something that feels like it's almost a commodity. Is that a worry?
It's actually where I feel about the market as well, right? So we've hopefully all enjoyed this upside in the stocks like Nvidia, the Mag 7 market with this huge 25% rally in the last 12 months, and is, let's say, perhaps approaching fully valued, if not a little bit concerning on the valuation. So what better to find a safe haven with a defensive stock, sells a commoditized product that is returning 25% to shareholders and is at depressed multiples. And so it's a lot about it being so boring and it being a telco, and it finding the huge growth in a commoditized market is going to be tough. But I will take you through the strategies that is going to see them return some quite exciting growth over the next 2 years.
That sounds great. And just on the returning 25%, now I think I read that Vodafone expects to cut its dividend by 80% in the coming, I forgot the time period, but some near future period. Is that return from current dividend plus buybacks?
So, and this is another thing that to appease concerns, Vodafone was trading on a 12% dividend yield. Okay. Now, obviously, investors saw that,
which is never sustainable. Yeah,
which is never sustainable, exactly. And that was priced into the stock. So at the year end, so 2024 year end, because it's a March year end. It was announced that they would cut the dividend in half. So it's a 50% cut to dividend, and it's roughly $0.05. Now, sorry, I'll change it into. So we'll stick to euros for this moment. It's 4.5 euro cents, which means in US dollars we're talking about 5 cents, but it's a 10 for 1 ADR, so 50-cent return, and the stock trades at $9 a share. So you're still talking about roughly a 6% dividend yield, even though it has been cut in half. But the real the thing that got me really interested was, yes, they were on a 12% dividend yield that was getting cut to 6, but they will do a 10% buyback this year on top of the dividend yield. So total return to shareholders, more like 16%. And then they'll do it again the next year. So you've got over 25% return to shareholders coming to you in the next, by my calculations, it's around about 18 months. But it's 6% dividend yield and it's 10%
Got it.
Buyback.
And in terms of corporate finance theory, if you believe a company's shares are undervalued, you want them to be buying back shares for the same reason you want to buy the shares, right? They're giving a disproportionately good return to investors. Obviously, if the shares were overvalued, if it's Nvidia and you think it's overvalued, you would not want them to buy back shares. But in this case, it would be quite good.
Exactly. And 4 years ago when we saw Tesla take off, in fact, I think it was 2021, then Elon Musk actually sold shares on behalf of the company because the stock was so high. And I think that was almost
Yep.
the all-time high that he did that. So exactly, we're in the complete opposite. Now, one reason for the buyback is because they are selling off parts of the business. Okay, they want to return to growth. So where they had a bit of stagnation was in Italy and Spain. So they've sold the Spanish business. They've just got the returns for that. And they're using some of that to pay down debt because the debt was looking a little bit high, not ideal. The positive there is that it's long dated debt. So there's not really any issue out to 2030. But for the ratings agencies, it was really good to get this back down to about a 2.5 times net debt to EBITDA. So that's the target now, 2.25 to 2.75. However, as well as paying down that debt, they are using 2 billion euros from the Spanish deal to buy back stock, and they're using 2 billion euros from the Italian deal to buy back stock as well. So overall, it's 4 billion buyback out of 13 billion euros of proceeds.
And Rich, just stepping back to the big picture, I think probably half the audience, let's say, knows about Vodafone in terms of some of the nuances of its business. Maybe half is new to the company. We mentioned it's a mobile operator, has some fixed lines as well. Am I missing any part of the business there?
But potentially the future. Right now, let's certainly what you've described is Vodafone of the past, but they are now targeting business to business, right? And that's where they see some real growth. And they've just done a partnership with Microsoft. And when you start hearing that Microsoft are interested in doing partnerships and, implementation of AI in the business, then you start to see, okay, this thing is completely unloved, but people aren't pricing in any benefit of strategy at all. And we've got three areas that we are focused on at the moment in terms of trying to spot when the share price might start reacting. The first is improvement in Germany. Okay, now Germany is 46% of the EBITDA. So
wow.
It's flat growth at the moment, right? We're not getting anything from that. So that's one of the main areas that the CEO and the new CEO and new CFO are both trying to get back to generating growth. So they're very excited about the B2B element of that because that's going to help them return to service revenue growth. And then the second area that they are interested in, I guess, judging themselves by is in the investments arm of the business. Okay, so they've reorged the whole business into Germany and UK, right, which a total equates of 60% of the business. And then you've got the rest of Europe and Turkey. And then you've got Africa, right? So there's huge growth areas in Egypt, all throughout Africa. And that's a company called Vodafone that they own 65% of.
And that's like 20% of their turnover, 20% of their revenue, right? Something like that.
Exactly. So, and growing quickly. So you've, so that's another part of the business. And then you've got this Vodafone Investments. And that is an area that they've only just established in the last few months. And that's all their smaller holdings and their towers. Now, I was lucky enough to get an interview with the CFO only 3 weeks ago. And something that I haven't heard before in that interview that he gave with us was that they're in talks with private equity about further sales of something called Vantage Towers. And that's towers that they own and are gradually selling off. And they did a deal with private equity a couple of years ago now, which gave them further proceeds. Now, any further proceeds like that are really not expected by the market. And they will, now that they've paid down the debt, these kind of things can go back into buying more shares back, right? So they're not looking to do deals. They're not looking to do huge amount of CapEx. And I'll come on to that in a minute for the reason why not. They are looking to generate returns and really start to show shareholders that they mean business here. And I think perhaps one of the biggest eye-openers to me was that the CFO has bought 4.1 million shares since joining the company last year. So he spent 3 million sterling, right? $4 million of his own money on buying
out of
shares.
his own pocket. It's not these are not awards, it's his own pocket. Yeah.
That's his own pocket. And the CEO just bought a further 250,000 sterling. So I think that would be 350,000 shares last week. So,
and she's an Italian lady, first female CEO, if I recall.
That's right. And she's been in Vodafone for years and years. The CFO, she managed to get him to come across from SAP, fantastic German company. And these two are really starting to gel together. And the strategy that they've done, the right sizing of the portfolio, has been really impressive. And the market's ignoring it. The market's not giving them whether it's the credibility, or they're just not rewarding them for what they've done so far. And I think it's going to come soon.
Now, I'm glad you mentioned it like that, Rich, because most people, or at least many investors, find a stock and say, oh, this stock is good, I want to buy it, or this company looks good. You have to look at the other side of the coin, which is, how does the market perceive it? If the company is just good and the market perceives it as great, it's a bad investment, right? Because it's underperforming expectations. You want to do the opposite, which is find a company whose prospects are better than what expectations are. And it sounds like you think this is that share. And I guess if someone's watching this saying, hey, this sounds a whole lot less sexy or exciting than NVIDIA, you would say, that's the point. That's the point. This is a company that doesn't need bells and whistles. It doesn't need a fantastic, exciting program. It needs to keep doing mostly what it's been doing in the past. Just wash, rinse, repeat. Am I right?
Well, and when you say wash, rinse, repeat, that takes me on to something I experienced at the weekend. When you have a leak,
a laundromat.
When you have a leak in a laundromat, when you have a leak at home, and you don't have enough paper towels, right? What happens? It doesn't look like you're making any progress at all. The water's still running everywhere. And that's the exact point we're at the moment with the buyback. And one of the reasons that I'm so excited about this, and I'd love to get my trading experience across to people in the next 2 minutes, is that I know what it's like to sit there and have a buy order every single day that is a high percentage of the average day volume. Now, I love that nobody's interested in this company. I love that nobody wants to trade it, because that means that there's only $100 million, $130 million, 100 million sterling of trade every day. And the company's buying back 10 million sterling of stock every day. So it's for the last 6 weeks that it's been starting to buy back stock, it's been between 10 and 15% of average daily volume. Now, when you've only bought 1%, 1.5% of the company back, you're still trying to mop up all the water. All the sellers that are still on old Vodafone and they don't like the stock and they've been looking for an opportunity to get out, you're mopping up all that, right? But when you get to a critical mass of 4 to 5% of the company that you've repurchased, and you're cancelling the shares, you've taken out all the easy sellers. You've taken out all the guys that have want to get rid of it for a while. And for the next 15% of the company that you're buying back, you've got to take that share price higher and higher to encourage people to sell. And that's the stage that we're getting at. They've now bought 1.7% of the company back, and they've got 18.3% left to go.
Wow. That's That's a long runway, so to speak. It actually feeds into my final question here is, how long do you plan to hold this position? I mean, the buyback catalyst will last a while, it sounds like, but not indefinitely. What happens after that's gone?
Yeah, absolutely. And he's very clear that this is the minimum amount that he's going to buy back. Right? They will also be looking to increase the dividend as the business turnaround. At the moment, they've implemented their strategy, and they've just started to do the right things, just like you do at the start of a presidency. Right? That's exactly the stage that they're at. They're pushing on the string at the moment, and they're not getting that much progress. In fact, Germany at the moment, he has highlighted, is in the trough of the numbers. Okay, so he has said it's going to be a U-shape 2025 full year, which we're now 3 months into, so it's a March year end. So we just had this bit in Germany. So the exciting thing is the numbers on the 25th of July. There's a trading statement on the 25th of July. Might not be that great, okay, but that's the low, and that's the low point. And from there on, everything ties together at this perfect time. And I expect to see some quick gains through the second half of the year, at a time that I think that markets elsewhere in the world may well be coming off. So, it's a real nice for me to move out of tech, to move out of S&P tracker, that kind of thing, and move into this defensive micro bottom-up story. So I see the main progress in the share price over the next 12 months, but I see it as an 18-month investment for myself to get that really nice extra cherry on top.
That sounds realistic. A year and a half minimum holding time. I mean, it's something that I would. I'm actually interested. Just hearing this. Let me add one more investing question, Rich, which is, let's invert this. In, let's say, 30 to 40 seconds, what's the bear case for this?
Absolutely, and the bear case is Germany. As I said, 46% of the revenues. There was a ruling that came out there that multi apartment multi apartment buildings that previously they all had, the building owner would sign the contract with Vodafone, so the whole building had to be with Vodafone. That was ruled against, and they're currently going through the negotiations with all building owners trying to. Now, first of all, it was thought that about 30% would re-sign with Vodafone, but actually they're on track for 50% at the moment. So that was a bear case, and that's one of the reasons why the stock hasn't moved. People want to see the results. But yeah, past that, then there's a merger with Three, which is another player in the UK. So the UK market is 4 operators, and Vodafone and Three are number 3 and 4, and they have gone into a merger agreement just in the UK. Now, that does mean that it's 4 players down to 3, which the Competition and Markets Authority doesn't always love. So that's going through a regulatory investigation at the moment. However, last week, then they did do a deal to remedy some of that. One of the points that the CMA made was that they were worried about the network, less competition in the network. They've done a deal with O2 and Virgin Media to alleviate one of those concerns already. So, they're playing with the authorities, they're playing ball, and hopefully that goes through. The final point I would add is that merger really creates $7 billion of cost synergies over the next 4 years. $7 billion. We're talking about a company whose market cap is only $24 billion, and we're talking about $7 billion of cost synergies. This is a really exciting name at very early stages of a resurgence, and you've got that market cap there, the buyback, mopping up 15% of sellers every single day.
Yep, and it's an established player. I could make a case that the competition, the authorities love to have multiple players, whether it's telecom, whether it's electric power in the US, but the market has shown that it's kind of hard to have too many. Those markets are either natural monopolies or at least natural oligopolies. And so, after three or four, it just kind of doesn't make sense. And I think that the companies become less innovative. They just have these price wars. So hopefully that trend will, for Vodafone's sake, hopefully that trend sort of stays in place, meaning we don't have too many little guy competitors, ankle biters, so to speak. It's just a few big incumbents, and Vodafone will be one of them. So great. Oh, go ahead, Rich.
Sorry to interrupt, James, but the new government in the UK, they want tech progression. They want infrastructure built in both the grid and with technology. They want the UK to be a centre of AI excellence. So to do that, you need to have a bloody good communications network. And that means 5G, that means Internet of Things. So there has to be a lot of CapEx, right? Because we don't have that at the moment. So the merger of Vodafone and Three means that the companies can get together and spend the CapEx necessary that they otherwise couldn't do. So, I'm confident that the authority will see the upside and that will bolster both companies to go on to some fantastic things.
Sounds good. And Center of AI Excellence sounds a little bit better than Center of Cryptocurrency Excellence, which was a prior goal, if I recall, from Sunak's team. Although I can't fault them. I've probably done the same thing. So, Rich, thank you so much for sharing this idea. If somebody would like to learn more about you, Rich McDonald, I'm guessing you no longer own fastest scotsmanalive.com domain. Where would you send that person to learn more?
Yeah, certainly. I'm on TikTok under Rich Macro Trades, and I also have an Instagram account called Rich on Macro, where I do a lot of my teachings and sort of daily basics of markets as well as some exciting ideas that we get on there. So yeah, Rich Macro Trades on TikTok.
Rich Macro is a lot hipper than I am. So thank you so much, Rich. I really appreciate this. Interesting idea. I like it very much. I'm a conservative investor, as you probably gathered, and this is exactly the sort of thing that I tend to go for. So hopefully there are others in the audience who feel as well. So Rich, again, thanks so much for taking your time to share with us today. And thanks to you guys, as always, for watching us at home.